Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Good morning and welcome to Wealth Coffee Chat Tax Tuesday. My name's Anthony Wolfenden. I'm a tax financial advisor and partner in the Positive Tax Solutions business. We're getting started a few minutes late today. We had some technology blow up in our faces, but we'll get straight into it. Today's topic is going to be on tax planning. We are in April, which means it's tax planning season. I hope everyone understands that. I'll go over why in a minute. But before I get started, I wanted to mention that the Positive Collective and the 6-star team are running the Property Summit on the Gold Coast, and that's scheduled for June 13 to 15. For anyone who's interested in elevating their understanding of the Australian property market and strategies for creating wealth through property, you should probably book and come and attend. We're going to have some wonderful guest speakers. The 6-star team going to be there to answer any questions. And it's a great opportunity to look at the full contact sport that is property investment with like-minded individuals. You can reserve your tickets for that, and there's going to be some info in the chat on that. And we'll just play a short video on the last event we ran.
All right, this is going to be fun. Who has played the property game before? Who has been in the game? Who's never played the property game before? Oh, you're in for a treat. Who likes Monopoly? Did anyone like Monopoly when they were a kid? Well, this is Monopoly in real life in this room. Every hour or so, you guys are going to be up and you're going to be running around the room like maniacs trying to play the property game and win the property game.
Today, I wanted to share the lessons, the mistakes, and the wins.
I want everybody to put up their hands who knows their interest rates on all their loans right now.
If you haven't seen me around before, like 13 years in the industry, in property management specifically.
Who likes paying tax? If you need help finding somewhere to donate, I'm sure I can find somewhere else where it can go.
No, we've got an expression in that, let's go and make new mistakes in the world. Who wants to make new mistakes?
These are just strategic moves that can make such a big difference.
So obviously buy well, never sell. Definitely the majority of what everyone's looking to do is collect some A-grade assets, B-grade assets, whatever it might be.
I loved the idea of being a property investor and developing that identity.
Collectively, they have way more years experience in everything that you think you're trying to solve. Because they do it every single day.
Well, thank you very much, guys, for sticking with us. We'll talk now a little bit about tax planning. So let's go over what that is, when we do it, why we do it, etc. First of all, the when. The when is basically now. We're in the last quarter of the financial year, 2025, and you should do your planning before the end of the year. Why? Well, tax planning is about reducing the tax you pay this year and planning to pay less tax next year. How do you do that? Well, you need tax deductions. That's expenses that are claimable. They've got to be associated with an income. You've got to have some evidence. They're the key things that you need to know to make a deduction. And you've got to have them in the year that the expense is incurred. That the income is earned and the expense is incurred. You've got to have the expense in the same year to claim it. And so you've really got to do your planning for the tax you're going to pay before the year's done, because when the year's done, it's too late. So now's the right time. Positive Tax Solutions is spooling up meetings with accountants in the next week or so that our clients can meet with us to go over their circumstances. And here's sort of the things that we really need clients to bring. You need to bring some documentation. Receipts are insufficient. Statements from a bank are insufficient. You need receipts to be able to claim an expense and have it valid with the ATO. They've said about 90% of tax returns for property investors are wrong. One of the key reasons is there's no evidence, there's no receipt. People are just using statements. So what's good, or what you have to do, is basically collect everything together. So things like rental income statements, mortgage statements, receipts for repairs or maintenance, insurance premiums and statements, or currency certificates, council rates and water bills, property management fees and evidence of those, depreciation schedules if you've got one, records of any capital gains or losses. If you've sold a property this year, that means contracting for sale between July 1st and June 30 this year, July 1st last year and June 30 this year, you really do need to see your accountant because you want to save on the capital gains tax. You need investment details of what you're doing with your properties, any tax records, any tax debt, last year's tax return potentially, and any PAYG installments you made this year, pay slips and so forth. So you want to bring that to your accountant. That's a lot of stuff. Record keeping is actually a complete pain for property investors. So one of the things I suggest you do now, if you haven't done it before, is make it easy on yourself and start to consolidate some of your expenses and reporting. In Australia, you might know this, but property managers can really handle the vast bulk of the property transaction expenses on your behalf, and they keep really good records because they've got to send them to you and you pay for that service. So when you get a property management statement, they can handle things like maintenance, repairs, utility and rates. They can pay those. They can pay your insurance premiums. Obviously, they're going to charge you property management fees. And there's various other compliance costs that will roll out, like inspections and so forth. So let your property manager do the hard yards. Try and run most of your expenses through them so that they do all the record keeping, for you. When you go see your accountant, what we want you to do is start asking some really good questions. What are the deductions that you're eligible for? How can you maximize them? Are there any new tax laws or changes that affect property investors? It is known for the ATO to change how they interpret a law and reverse a tax ruling with no actual change in legislation at all. How does that impact you? A key question: if you are on a payroll arrangement, you're getting paid through salary, and you get a pay slip, if your properties are running negative during the course of the year, you're possibly paying more tax than you ultimately will pay. You should ask if you would benefit from a payroll or PAYG variation. If your accountant says that you wouldn't benefit from it and you know you're going to get 4, 5, 6,000 or more back from your taxes, change your accountant because they don't know what they're talking about. Make sure that you deal with any capital gains tax issues. As I mentioned, if you are contracting to sell a property this year, not closing the property, just having the contract inked, that's the capital gains tax event, then you should talk to your accountant or your planner about how to minimize your tax. You can save 5 digits worth of tax. I've worked with clients to save them over $30,000 in tax if we get to before the end of the year. Talk about your long-term goals for the property so we know how to deal with it going forward. Any compliance issues, ask what the ATO is looking out for this year so that you don't do it. And then talk about the future year. On the payroll variation, we've talked a little bit about that. There is absolutely no point if you're on a pay slip and you are running negative on your property, paying tax and getting it back at the end of the fiscal year. The ATO doesn't pay you any interest for your money that they've had in their bank account for the course of that time, but you're certainly paying interest on any mortgages that you have. So it would be better that your pay slip is modified, your withholding is reduced, your net pay goes up so that you can put that in your offset account and reduce the loan interest bleed to the bank. So you would request that again if you're on a payroll and if you're running negative. If you're self-employed, you get to manage your own tax affairs, but that's another conversation you can have with your accountant. When you work for yourself, it might be that the income goes up and down. You could have good years, you could have bad years. Being able to smooth out that income across year boundaries is something you can talk to your accountant about to pay less tax in a great year and maybe top up a little bit in a poor year, smooth out, be in a lower lower tax band, tax rate, and work out better than that. For variations, you do, just going back to that topic, they do only last for a year. So make sure that you get that updated and ready to roll as soon as you can when the new fiscal year starts, because they only go out for about a year. Okay, in terms of the walkaway, what you're looking to do is obviously pay less tax for this year. That's great. Understand the tax you're up for, how to keep more of it in your pocket, and make sure you understand what you're up for in the following year. And property is one of the key ways to do that. So that's it on sort of tax planning. I encourage you to organize time to speak to your accountant now. Hopefully meet with them in the May timeframe before the beginning of June, because if there is action you need to take, you need to leave aside space before the end of the fiscal year to move things around. It could be contributions to super to minimize capital gains tax, things like that, strategies that can be implemented, but they do take time and they've got to be done well before the end of the fiscal year because certain things stop before the end of June even. Okay, guys, I'll leave that be. That's it for Tax Tuesday. Get your tax planning done and all the best with paying the least amount possible.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts